Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and I hope you're having a good day. We saw the China data come out, Q2 GDP, 6.3%, that's for the year, but for the month we dropped from 2.2% down to 0.8%. I actually think the Chinese economy is running at about 4.6, 4.8%, somewhere around there, because you've got to remember there's a lot of base effect and distortions still flowing through this data series from the lockdown period. So we've seen the recovery out of lockdown, not as large as most people expected, but as we forecast, it would be less than market expectations. And now we're going to see a softer landing than some people think we're going to see, as the Chinese economy really does find its feet now for what is a new era of sustained, more modest, but still very strong by Western economic standards, growth. So a positive outlook, but not to take away from the fact that the Chinese economy has been slowing and will continue perhaps to slow through Q3, stabilizing into Q4. This is partly due, of course, to the still dire state of the European and US economies, which really continue to languish in a very weakened state. We saw yesterday the Fed Empire manufacturing index for New York region yesterday, and that was basically flat and has had some big negatives in the not too distant past, so that's a very subdued outcome there. We're going to see US retail sales, industrial production numbers tonight. I'll be watching closely, just see how that manufacturing side of things is going in the US economy. It deserves to have a bit of a bounce because it's been so lackluster for so long now. In markets, we continue to see a little bit of a rolling over in equities, and the US market did try to go, you know what, everything's fine, we'll rally at first yesterday, which I thought I did say we'll see if we can climb back into the range, and we did. But again, the market has closed weakening towards the bottom and out of the bottom of that range of the last couple of days. So I suggest there remain significant price action concerns about the US stock market at this point. And remember, I gave that tip yesterday of Dow Jones 34,150 to 200 level to keep an eye on as important support. Below there, particularly a close below 34,150, would be very worrying indicator for the US stock market in general. Some of the other things we've seen that are of interest and noteworthy are, for instance, Russia saying it's not going to renew the wheat deal, that is to allow the exports of Ukrainian grain. And the reasons behind that are that really the other side of the equation didn't really stick to all the parameters that were initially agreed to, and that those sea lanes actually have been used to mount a tax against Russia. And part of the grain deal was that that wouldn't be the case. So it's not a nice thing for Russia to do, but at the same thing, it's not a purely one-sided event, this process. We also saw Russia seize two European companies, I think they were, assets in Russia. And everyone thinks that's so terribly bad, but what has the West been doing to Russian assets and oligarch assets? So we'll just see. Those companies might have been winding down their operations anyway, but those operations have now been seized, and we'll see how that plays out in terms of if there's any further sanctions by Europe and the US toward Russia in a kind of tit-for-tat game as a result of that. None of this really helps global trade, so I remain very cautionary on the global growth path overall over the next 1 to 3 years. And that means that, too much euphoria about stock buying. Sure, there's great companies to buy out there, but too much euphoria about buying stocks at the moment could well prove to be misplaced. I was thinking the US dollar could have a short-term bounce, but it's struggling to achieve that. Nevertheless, I am a little bit bearish the Australian dollar, and I do continue to like gold a great deal. Oil had a bit of volatility yesterday, but it could be a little bit of a cautious, and I do stress cautious, buy the dip on the day for a sort of 2 to 3 week outlook. But gold, I think, is going to be a steady achiever, albeit with some volatility from time to time. Over in Europe, things continue to look a little bit suspect on the economic growth path. Germany is now having significant industrial and property downturns in the midst of an already established recession, and those economic contraction forces are spreading through other economies in Europe at this point in time. So I still do see a recession in Europe in the second half of the year, and lackluster, if not recession, lackluster economic growth for the US for a sustained period of time. And we need to be aware of that macroeconomic backdrop, even though markets can just act with glee on the basis of greed, and particularly with share buybacks and other interventions that have occurred in various major stocks, and that meme trading trend, which is every day the meme traders, what do we buy today, and rushing into 1, 2, or 3 stocks. That also has been distorting, I think, the indices to the upside a little bit. So despite all the good news in terms of price movement over recent months, I'm still a little bit stubbornly suggesting a cautionary approach. Have a great day. Clifford Bennett, Chief Economist, ACY Securities.